we are going to get started. Thanks for joining us tonight. I am Erin. I'm the Director of Financial Planning here at EP Wealth, and I also have our entire financial planning team here as well, who you'll hear from. Allison Sabrin, Alina Nar, and Jennifer Lee will all be speaking tonight. We're going to basically walk you through tonight kind of everything you should be thinking about from a financial planning perspective as a younger age. We're going to walk through a lot of information, so our goal is to make all the questions kind of happen at the end. So if we could hold questions till the end, that would be great. There is a chat box up in the top part of the free conference call bar. So if you want to start putting questions in there, you are more than welcome to, and we'll address them at the end. So with that, we will get started with the presentation.
Great, so I'm up first. This is Jennifer Lee. Just want to also point out on the free conference call, if you do see this big gray box in front, you can minimize it by pressing the arrow here, so that's not in your way. And at the end, when we're asking questions, you can open the box again and type in the chat box and ask your questions. Okay, so we have quite a bit to cover today, and these are some of the things we will cover, so including how to set goals, how to budget, ways you can use and build credit, establishing an emergency fund, taking advantage of your employee benefits, looking at insurance, what types of insurance you may need, how to invest, and plan for your retirement. Okay, so the first step in financial planning is establishing your goals. So your goals may be kind of far or maybe close in future. So some closer goals may be like buying a car or paying down your credit card debt. Some more far off goals may be buying a home or starting your own business. Maybe you're thinking about paying for your kids' college, or maybe you're thinking about retiring early. So when you're thinking about your goals, you want to think about how SMART are your goals. So SMART is an acronym for specific, measurable, attainable, relevant, and timely. So a specific goal is something that is clearly defined. So something like, I want to save for my child's college education is not really a specific goal, but saying I want to save the cost of 4 years at a homegrown university by the time my daughter turns 17 is a much more clearly defined goal. Next, your goal wants to be measurable. This allows you to track your progress and know when you've hopefully reached your goal. So for example, saying I want to retire early is not a measurable goal, but saying I want to retire by the time I'm 55 is a goal that has a definite endpoint. An attainable goal is something that's realistic and reachable. Goals can be challenging already, so you want to give yourself a fair chance of achieving them. So saying I want to save $1 million in 5 years is probably not attainable, whereas saying I want to save $1 million in 30 years might be more attainable. Your goal should be relevant. So this is something that makes sense for you. This is something that you actually want to achieve. So it'll help you get excited about reaching those goals and help you define what's important to you. So for example, I want to save $25,000 for a down payment. May make more sense because this will help you own your own home if that's what you're looking to do. And finally, you want to have timely goals. So try and set time frame or a deadline for reaching your goals. So for example, I want to pay off my credit card debt by the end of next year is a good goal that has a clear deadline and so that you can achieve it. So you want to start by writing down your goals and prioritizing now that you've kind of started thinking about it. So when you're setting and prioritizing your goals, you want to start by asking yourself some questions. What are my short-term goals? Short-term goals might be buying a car. Maybe you're saving for a vacation you want to go on next year. And what are my intermediate goals, such as buying a home? And what are my long-term goals? Maybe you're thinking about saving for your child's college or retirement. Next, you'll want to rank how important these goals are to you. And from there, you can start to figure out how much do I need to save for each goal. Once you have a clear picture of these goals, you can establish a budget that can help you target those goals. So to start, here are some common goals that younger folks might have. The first is you maybe want to try to eliminate your credit card debt, and then maybe you want to establish an emergency fund. And finally, you might want to open and contribute to a retirement account. So if you're in your 20s, you might want to start with 5% of your salary. When you're in your 30s, you want to increase that to 10%, 35 to 15%, and 45 to 20%. So debt. Credit card debt is a way that creates debt for you. When you borrow money, this becomes debt to you. There are two main types of debt, secured and unsecured. Secured debt means there's something tangible attached to it. So for example, if you take a mortgage, there's a home attached to it. Unsecured debt, on the other hand, is something that isn't tangible. So like credit card debt, student loans, these are things where they can't put a lien on a property per se. When you're thinking about how much debt to take on, there are a couple things that you'll want to consider. First is how much debt, the term, and the rate, and if there are any rewards. So some credit card companies give you rewards, so you want to look at, is it worth it to take one card versus another. The amount is also very important because that tells you, is this affordable and can I budget for this expense every month? So if you've already eliminated your credit card debt, that's great. What you might want to consider building is an emergency fund. So we usually recommend that you have at least 6 months of reserve in your non-discretionary expenses, just in case something happens. Emergencies may be like if you lose your job, if you become disabled, or your car breaks down. I can personally attest to this. I had this happen a few weeks ago, and I had to pay a hefty amount for fixing my car. So thank God for that emergency fund. Basically, it's not spending money for you unless something truly happens. So knowing these numbers when you're getting started with your financial plan is really important. Know your net worth. Your net worth is your assets minus your liabilities. So your assets may be your bank accounts, your investments, your car, your home, minus your liabilities, which may be like student loan debt, mortgage, etc. Know how much you make and spend each month. Knowing this can help you budget. A great free way to do this is mint.com. It's an app where you can track your income and your expenses. It'll send you text messages if you go over budget and tell you you're overspending in this category, watch out. And the next thing you want to know is spend less than you make. So this may seem really obvious, but you'll be surprised how many people don't know how much they spend and sometimes go over and are in a deficit. Another thing you want to consider is automating your savings. I call this the pay yourself first rule. If it automatically goes in, then you're done. You've already paid yourself, and whatever's left you can, budget and spend on whatever you have left. So you may consider opening a bank account at a different bank than where you normally bank, so that, I think if you don't see it, you're not going to spend it. So if you say I'm going to save $10, $50 every paycheck to this account, you're already automatic savings. Another thing you might want to consider is 401k matches. Take advantage of those. That's free money you're leaving on the table. So I definitely recommend taking advantage of that, saving into your 401k. Knowing your credit score is really important because this helps you determine what kind of interest rate and debt you can take on. Pay down debt, and know your total compensation package. Your employer gives you more than just your base rate, your base pay. There may be other benefits, such as disability or insurance, that you may have that you may not be aware of. We'll definitely cover more of that later in the presentation. The next part we're going to dive in a little more is budgeting and credit. So budgeting is quite simple. You have your income minus your expenses. So income is your paycheck and any other income you might have, such as maybe your babysitting or dog sitting, and then minus your expenses. Usually I like to break it down to your fixed expenses and your discretionary expenses. Do the math and you can either come up with a surplus or a deficit. If you have a surplus, you want to think about, are there ways you can more efficiently use that savings to meet your goals? And if you're running a deficit in the red, then you might want to think about, are there ways I can increase my income, or can I decrease my expenses and cut somewhere? So I have a general guideline called the 50-20-30 rule of how you should budget. This is something that's just a guideline, so you may not be able to do this right away, but it's a goal you want to get to when you're thinking about your budgeting. So here's a visual of how this works. In the green, we start with your income, and then we divide into 3 buckets: your needs, wants, and wishes. Your needs is 50%, so this is anything that you have to live on. So rent, auto and transport, utilities, your groceries, things like that. So if the world came crashing down, these are expenses you need to spend on. Next is wants. So this is your savings, your goals, your financial goals you're trying to attain. So 20% of your income should go towards paying down credit card debt if you have any, creating an emergency fund, saving for retirement, or any other type of financial goal you are trying to attain. And finally, this is the fun bucket. 30% goes to your wishes. Fun money is for now, you don't want you to become frugal and never spend and have fun. You got to live your life too. So entertainment, if you want to go to the movies, you want to go out, dining out, if you want to buy people gifts and donations, this is the bucket you can pull from. So what I have up is our personal financial site. This is a personal website that we give to current clients. So if your family is a client of ours, talk to your advisor. This is where we can track in real time your net worth and help you track your spending and budgeting. So next, let's talk about credit. So there are 3 C's of credit. These are the things that creditors will look for and when they're thinking about if they should lend you any money. So capacity, character, and collateral. So capacity is your ability to have credit. Are you able to pay them back? So the way they decide on this is looking at your income, your expenses, if you have revolving debt. Your character is important. So this is even if you have the money, will you actually pay back? So for example, they'll look at your credit report and see that you have a history of paying 100% on time and actually paying off your debts. And finally, collateral. Is there something they can seize if you do not pay off your debt? So that could be a home or a car if you have an auto loan. So how creditors determine your creditworthiness is through your credit application. This is where they ask for all your personal info. A credit report that shows your history of what if other lenders have lent to you, if you've been on time with your payments, what kind of balance you've been holding, and finally your credit score. Your credit score is going to tell them how high of a risk you are at paying off your debts. So the higher the score, the better. 850 is the highest. I've yet to see anyone have that, so you should let me know if you do. All right, so credit score is very important because it allows your potential borrowers to know if you are going to pay back your debts. There are several factors that can negatively impact your credit score. So the first is a history of late payments, not enough good credit. So that means that people haven't been lending to you, so nobody wants to be the first one to lend to you if they don't think anyone trusts you. Too many credit inquiries, so you're applying for too many credit cards. You might want to stop that. And uncorrected errors on your credit report. Okay, so this is like an identity theft problem. You'd be surprised how many people are trying to report things or buy stuff with your card and you don't even know it. So if that's the case, you might want to call that credit bureau and tell them that's a mistake, that's not me. So a great way to keep track of your credit score, and I do this myself, is using creditkarma.com. This is a free site. So what it does, it tracks your credit score. It also gives you the 6 factors that affect your credit score. It will show you which ones are high, medium, low impact, and ways to improve your credit. So for example, one of the highest impacts is your credit utilization rate. You can see it kind of down here. So credit utilization rate tells your credit score, how much of your credit limit do you use on a monthly basis. So if you use that a lot, and a way to lower that down is maybe paying twice a month your credit card payments. That way every month your balance is not as high as it would be if you only paid once a month. Paying on time is really important. 100% on time. If you go down to 99%, your credit score will drop rapidly. So definitely want a perfect score on that. A way to do that or keep that up is to automate savings. There's usually an auto bill pay you can connect to your bank account, so I highly recommend you doing that. But do make sure you have enough in your checking account, because bounce checks are not a good thing either. For more factors for your particular situation, check out Credit Karma. Okay, the next part of our presentation, I'm going to turn it over to Lena Nar, is planning for major purchases.
Okay, hi everybody. So especially since Jen just got done talking about credit, that may play a big role when you're thinking about planning for major purchases. So first thing we're going to talk about is, should I buy or lease a car? So this is something that you may ask yourself when you're getting ready to move on to the next car. So we just came up with 3 things that you should probably think about in making your decision. So for one is, how long will you keep the car? So if you are the kind of person that wants longevity and you want to have the car as long as possible, then you may want to go with a buy option. If you like to have a new car every few years, and that's something that you would like to try out, maybe a lease option would be the best for you. Second thing to think about is how large of a monthly payment you can afford. So usually for a lease, the monthly payment tends to be a little bit lower. If you are buying and financing your car, the payment may be a little bit higher. So you think about your comfort level and your budgeting and kind of where you stand every month with your cash flow and see what you can afford. Third thing to think about is, how will you treat the car? So, you know, from personal experience, I'm sure if you own your car and you're paying that payment every month, you are probably going to be more likely to take better care of it. One thing is to think about, if when you are leasing a car, there are limitations as to, you know, how many miles you can drive. So if you are a person that drives a lot, you know, you're driving to Vegas or whatever it may be, maybe having your own car and owning the car may be a better option in that case. So it's just a few things to think about when it comes to a new car. Next major purchase may be buying your first home. So this may be a little bit intimidating at first. I just went through this myself. This is very fresh in my mind about this whole process. So definitely the first thing you should think about is how much you can afford. Now, this is not just about, you know, how big of a loan can I be approved for. You really need to look at your budget and really think about your take-home pay and the expenses that you have and how much you can actually afford out of pocket every month. On, you know, your mortgage, you also have to think about property taxes and insurance, and probably a little bit higher costs in utilities and other home costs compared to renting. So the budgeting, how Jen talked about earlier, is a major part when you are making the decision to buy your first home. Generally, if you're applying for a conventional mortgage, your monthly housing expenses, which is your mortgage principal and interest, the real estate taxes, like I said, and homeowner's insurance, those should not exceed 28% of your gross monthly income. So that's before any taxes are paid. Another thing to think about when you are applying for a mortgage loan is your debt-to-income ratio. So lenders are going to look for something that is less than or equal to 43%. What this means is you should be spending no more than the 43% of your gross monthly income on long-term debt payments. So they'll take into account any student loans that you may have, and any other long-term debt. Like if you do have a car loan, they'll take into that will play into the 43%. So those are just some things to think about in the beginning. Definitely one thing that's not up on the slide is your credit score. You probably want to work on that very early on. Go on Credit Karma, see where you stand, and see how you can change your score to be in a better position. Next thing we're going to look at is your financing options. So these are the types of mortgages that may be available to you. Number one is a conventional loan, which is probably the most used. So this is a fixed interest rate for a specific period of time. Normally it's a 30-year. And you pay principal and interest payments on the loan every month. Another type of mortgage is an interest-only loan. This is also a fixed rate for a specific period of time, but normally those time periods are a little bit less than the 30 years. So generally they're 5, 7, or 10 years. The rate is fixed for that amount of time, and then after that the rate can adjust. Payments are interest only, so your principal amount theoretically is due up front at the end of the term. So normally when you come to the end of the 5, 7, or 10 years, you may want to think about refinancing or some other options at that point. We also have an FHA loan that may be available to you. This is a loan that it's federally backed, so it's backed by the government. It allows for a smaller down payment. So I think this is becoming definitely more popular for younger buyers, and you only need about 3 to 5% down payment to qualify for an FHA loan. But since you're not making that 20%, that's normally what the norm is. Normally there is a higher monthly payment because you then have to purchase mortgage insurance, which the lender just kind of wants that on there to make sure that you're making your mortgage payment every month. Here we have a buying a home checklist. So these are things that you kind of want to think about and things that you'll need to kind of go through this process. So first thing to do is to get pre-approved. They're going to ask you for a lot of information. So these are just things to kind of organize beforehand. They're always going to ask you for at least 2 years of your tax returns. Obviously you would definitely want to make sure you have a pretty good credit score. A 740 score seemed to be pretty normal, or what the lenders want to see, at least when I did this process a few months ago. So at least a 740 score, you're in a good standing. They're going to ask you for all of your bank statements showing funds of where that down payment is going to come from. They're going to want to see your pay stubs. So pay stubs from work, and if you are married, they're going to want to see both of yours, and this is covering the last 30-day period. This is not only asked in the pre-approval process, they may ask for this later on as well. So just keep all of these things organized, I would say. They also want to see your investment account statements covering the last 60 days. So any 401ks, brokerage accounts, they're going to want to see those statements as well. And of course, they're going to want to know what your expenses are and any other debt that you have, which as far as the long-term debt, they will also be able to see this when they run your credit score. You also want to get a real estate agent, start looking for a home. There's a lot of websites out there where you can do a search with kind of your budget in mind and the area that you're looking for. So having a general idea what you want. Once you have a real estate agent and start looking for homes, obviously you're going to want to make an offer on something you like. And if your offer does get accepted, then there's other fund costs that you want to consider. I would say a lot of these you definitely don't expect when it's your first time buying a home. So just something to look out for. There are closing costs that are not, it's not just a few $1,000s. They can get pretty costly. You want to have to pay for a home inspection, appraisal of the home, title insurance. Since you are going to purchase a home, you're going to need homeowner's insurance on the home as well, so you'll need to do some shopping there. And budget for other things you'll need. So, since you are going to hopefully be purchasing a home, you'll need to furnish it, maybe get some new appliances. So it's not just about the down payment and closing costs. You definitely want to build that savings to have a little buffer for other things as well. Okay, so next thing, Erin is going to talk about employee benefits and insurance. I'm going to turn it over to her.
All right. So first up isn't necessarily an employee benefit or insurance, but it's something that as you become an employee someplace, you're going to see both of these forms. And they often get confused. So the W-2, this is basically what you're getting at the end of each year from your employer that says how much you earned from that job and all of the taxes that were withheld. It'll also include information on retirement plan contributions you've made, your health insurance, and any other employee benefits that you have paid for or that your employer has paid for on your behalf. The W-4, this is when you start a job generally and you're filling out this form and basically saying how much taxes do I want to withhold from my paycheck. Generally when it's your first job, you're going to be basically putting 0 or 1, which basically says take as much taxes out of my paycheck as possible because you don't have a lot of write-offs at that point. So you're going to want to make sure that you're withholding enough taxes. As Alina just talked about with buying a home, once you start to kind of buy a home, have different things that you can itemize, your W-4 will change and should be something that you update as your financial planning situation changes. So when we're looking at a W-2 versus a 1099, so a 1099 basically says you are your own business owner, more or less. You're considered an independent contractor. The reason this differs from a W-2 is that you are responsible for all payroll taxes. So a lot of times people that get 1099 income submit estimated tax payments on a quarterly basis to the government. You also generally have your own medical insurance when you're an independent contractor. When you're a W-2, your payroll taxes are automatically deducted from your paycheck, as well as any employee benefits that your employer is paying for or that you're taking advantage of yourself. So this just kind of highlights a quick overview of what your paycheck looks like. It's important to look at your paycheck. A lot of people have direct deposit now, so it shows up in their bank account maybe every 2 weeks or every month, and they just don't look at it. It's important to make sure that just everything looks right on your paycheck. So are your deductions accurate? As you start to earn higher incomes, there's going to be a point in the year where your Social Security tax will fall off. So you might get to maybe September, October and start to say, wow, my paycheck looks bigger. Why did that happen? Generally, it's because of that Social Security tax, but it's also important to know maybe you've maximized your 401k at that point. So just reviewing your paycheck each time you get paid is just important. Health insurance. So this is probably the most confusing part of starting a job and figuring out, okay, what kind of health insurance do I want? Most, people when they're starting off are saying, okay, what's the cheapest? That's what I'm going to go with. The different types that are generally offered are HMO, PPO, and POS. So HMO plans are usually network plans. So a common one is Kaiser. That is a very common HMO plan. PPO, this is basically when you have the freedom to go choose your doctors. So if you want to see certain doctors for different things that you may have to see doctors for, you have a little more flexibility here. And then point of service plans, probably not as common, but they're definitely a combination of the HMO and PPO plans and still offered by some employers. Understanding health insurance. So, you sign up for your insurance, you go to the doctor. These are just kind of the common things that you need to think about. So the deductible on the plan. That is basically the amount that you have to pay out of pocket before the insurance will actually start to kick in. The co-insurance is the amount that you're responsible for. So generally this is going to be an 80-20 rule. And then the copayment. This is going to be when you go to the doctor and they say, okay, your copayment is $20 or $25. And then your out-of-pocket maximum. So this is basically on the policy that says this is the most you'll have to pay out of pocket before the insurance kicks in and pays 100%. Why these are important to look at is if you're planning on having certain surgeries, while we're financial planning mindset, there are points of the year where this is more prudent to look at. So maybe you don't want to try doing all this in December because you haven't hit your deductible. So if you hit your deductible earlier in the year and you're going to have a big surgery, you can kind of plan to take advantage of maybe some more doctor's appointments, I will say. I did this personally when I had knee surgery. I scheduled it at the beginning of the year, hit my out-of-pocket maximum, and then went to every doctor I could think of for the rest of the year to have it paid for. So other benefits that you may be eligible for as an employee. So health savings accounts and flexible savings accounts. These are basically two separate accounts you can have to pay for medical expenses on a pre-tax basis. Health savings accounts essentially act similar to an IRA. This basically allows you to save money into an account on a pre-tax basis for medical expenses, but the big thing with this plan is that that money can roll over year after year. So if you're saving into it and don't use that money, it can accumulate and be another form of a retirement asset to you. The flexible spending account has a lower limit that you can save, and it has to be used by the end of the year. You do have a grace period generally into the following year, but if you don't use it, you lose it. So this comes into planning your budget, saying, okay, how much do I typically spend on medical expenses? And that's how much you should be putting into the flexible spending account. Both of these accounts allow you to pay for a lot of things that people don't think about. So you'll find these people, in December right now, end of the year, that maybe have $500 left in their flexible spending account, racing around the aisles of CVS or Walgreens, buying over-the-counter medicines and, suntan lotions, and things you don't think about that you can use it for, but there's actually a lot. So these are two benefits that I don't think enough people take advantage of when they have them, just because a lot of times they don't understand them. But it really can help. And then the dependent care flexible spending account. This allows you to pay for child care expenses on a pre-tax basis. So if you have your children registered, and I say registered because it has to be, a legitimate daycare or school, you can actually deduct expenses through this account. Some other benefits that people have are prepaid legal plans. Why these are helpful if you're just starting off with a family and maybe you need your estate planning done. So this is a very low-cost way to have your estate planning completed. It basically gives you access to a wide range of attorneys at a relatively low cost. So generally you're paying maybe $15 to $20 a month, and then you have access to lawyers in a variety of fields. Health and wellness benefits, so a lot of times this can be, I know a past employer I worked for offered this, so if you were stressed out, there were counselors you could call just to kind of talk through things. Some of them sometimes are gym memberships where they give you kind of a gym membership credit. Life and disability insurance, these are pretty common that employers will offer. And then employer stock plans. So with a lot more of these startups happening, there's a lot more companies offering stock incentive plans. But going through your employee benefits when you start and kind of making sure you understand everything that's offered is really important, because you can only really take advantage of these each year during open enrollment. So we'll talk a little bit about life insurance, because generally a lot of people write this off when they're younger as, I don't need it, I don't have a family, I don't have kids, I don't have a house. So the purpose of life insurance generally is to protect against, essentially loss of income, making sure you can pay off maybe a mortgage, funding your children's education. There's usually a purpose for why you get it. Why getting it at a younger age is helpful is because it's going to be cheap. Life insurance is especially term, which we'll talk about, is relatively cheap at a younger age. So term insurance is basically a way that you're going to pay for either 10, 15, 20, or 30 years a fixed premium for a certain death benefit. So this is the most cost-effective way to have life insurance and insure your family against, the loss essentially of your life. Permanent insurance is also something that people will get proposed a lot by different people, and that's the universal life, whole life, variable universal life, or even indexed universal life are kind of the more common types. And these are basically insurance policies that allow you to potentially build up cash value. So these will get sold as investment products as well as life insurance. There's a lot of different caveats to that, so if you ever get proposed a permanent life insurance policy, definitely make sure you're discussing that with a financial advisor, because there's usually surrender charges and certain periods of time that you're stuck in these policies and cannot get out of them. So auto insurance. Won't run through the whole alphabet, but basically auto insurance, what you need to be concerned about is really your coverage limits and your deductibles. So coverage meaning you want to ensure, collision and comprehensive is on there. Newer cars, you're really going to want to make sure you have good coverage there. You'll see some companies drop that. If you have like a 1990 car, you might just have liability coverage. But this is basically insuring you against accidents or those, things falling on your car, potentially running into a telephone pole. And then the deductible. So a lot of people tend to keep the deductible low because they're thinking, okay, I don't have that much cash. But this is where, as Jen talked about, having that emergency fund is really important, because that deductible is what you have to pay out of pocket first before the insurance company is going to pay. So if you're accident prone, it's probably wise to keep a low deductible. If you have a good driving record and you'd rather pay more out of pocket than risk having your auto insurance go up, have a higher deductible, because that might lower your premium on the other end. Renters and homeowners insurance. Renter's insurance is basically a necessity that if you're renting an apartment or a townhouse or a house anywhere, it's definitely something that you should have, and a lot of people tend not to because they don't want that added expense. But this is basically protecting your assets in that house. A lot of people assume that their landlord would be responsible if there was a fire or something got stolen, and really it comes down to having a good renter's insurance policy. And homeowner's insurance, as Alina mentioned with buying a house, is absolutely necessary. Most mortgage people won't even actually finish the underwriting process until your homeowner's insurance is in place. And again, this is basically protecting your home against theft or fire, things like that. So now we're going to turn it over to Allison, who's going to talk to you about investments.
Okay, and today the types of investments that we're going to be talking about are investing in the stock and bond market. And you will notice that we have investments kind of towards the end of the presentation. That actually is done rather intentionally, because the way you should look at investing in the stock and bond markets is there is a degree of speculation involved. There is a degree of market risk. Therefore, you always want to have your emergency funds and savings accounts in place first, because ideally the money that's going into the stock and bond markets you don't want to need to touch in the next 1 to 3 to even 5 year time frame if you're being very conservative about it. So why invest in the stock and bond market if there is risk and if your principal even is at stake? Ultimately, with savings accounts, you're only going to earn maybe 1% these days. So to really outpace inflation and accumulate wealth, you do need to take on a little bit more risk with some of your portfolio to reach some of your more long-term goals. Okay, so the first type of investing that people think of is investing in the stock market. And really, what does that mean? So we'll take Apple, for example. If you own Apple stock, you actually own a piece of the company. And if the company does well, like it has for the last 10 years, you will have a little bit of that earnings. So you want to grow, and you want the earnings to grow over time, and your stock will appreciate. companies, when they're in their beginning stages, often will not pay what is known as a dividend because they're reinvesting into the company and they want to keep developing new products. But over time, we'll even see a few years ago, Apple came out and started issuing what's called a dividend, where their shareholders get a set amount of money every quarter for being part of the owners of the company. And historically, stocks have provided the highest rate of return of other investments. So people are, in a sense, taking that gamble and investing in stocks for the hope that the companies will grow and you will see appreciation on that growth. A nice thing about the stock market is it's relatively easy, although I said you don't necessarily want to have to touch that money in the short term. If you did need to, you could sell your stock and you'd have a check within 3 days. It's just an operational transaction, whereas if you were invested in real estate, it could take quite a bit longer to get out of that. Some disadvantages of investing in stocks is, you might think a company is great and there might be other things going on behind the scenes that could affect their performance. There could be accounting fraud, or, if you're a medical company, they don't get a patent and suddenly the stock tanks a lot. So there are factors that maybe you don't foresee that could come up. And then there's also just the market in general, something like September 11th or the housing crisis, that you might be in a great company stock, but due to the economy as a whole, it could affect your stock position. And it's not just your earnings that are at risk, it is the principal that could go down as well. Whereas now shifting gears to bonds, rather than owning a piece of a company, you are lending a company or a municipality or the U.S. government, depending on the type of bond, you're lending them money and they're going to pay you a steady stream of income over time. And if you were to hold that bond to maturity, ideally you would get your money back. So you tend to see this. The advantages of this are you do have that predictable stream of income. So a higher percentage of bonds in your portfolio towards retirement, you'll see, because people want that steady stream of income. There is still some risk involved investing in bonds. For example, if you're in a municipality and it's a water project, it could default. The program could not work, and they could potentially not pay back the money that you lent to them. And then also bonds are also subject to the economy and what's going on with interest rates. Can have an effect on the ultimate value of your bonds if you were to sell before maturity. So how do you balance out, investing in stocks and investing in bonds and what's right for you? So you've got to look at it as, one, having both stocks and bonds in your portfolio helps to diversify, because they don't always move in the same direction. So sometimes when the stock market's up, the bond market's down, and vice versa. So having both in your portfolio does help stabilize. To further diversify your portfolio, especially when you're starting out, you may not want to buy just one or two stocks or one or two bonds. That's putting a lot of risk in one company, or as the illustration shows, all your eggs in one basket. So how you could further diversify using stocks and bonds is to buy what's called a mutual fund or even an exchange-traded fund, and that's just a pool of a lot of stocks or a lot of bonds where they have relatively low costs. You could get into some mutual funds and ETFs for as low as $50, and you're actually owning quite a bit of different stocks and bonds. And then how you should allocate between stocks and bonds, a lot of it has to do with your own risk tolerance. Some people could sleep at night knowing they're all in stocks and there could be a lot of volatility, and other people it makes them more nervous. So that's definitely something to consider when you're investing, and something that your financial planner should be reviewing with you. Another thing as far as your allocation goes is your time frame. So I already mentioned you probably don't want to be in the market if you plan on needing that money in the next year. But the farther out you look, if you're saving for your retirement by investing in the market and you're 30 years out, you should be able to handle the short-term volatility, and over time your portfolio should stabilize. So having more stocks in your portfolio, if you're further out from needing the money, could make sense. And of course, you got to look at your personal situation. If you have a major purchase coming up, you know you're going to buy a house, it's probably not best to put all that money in the market if you're planning on taking it out anytime soon. And then when we're talking about diversification, there's also lots of different types of stocks and different types of bonds. So there's large company stocks, there's small companies that are up and coming, there's international stocks and international bonds, and you could see over time, when we talk about volatility, over time, over the last 20-year period, they have all, if you stayed in the market for 20 years, all are higher than where they started. But you'll see some of the categories have a lot more volatility over time. So you'll see large cap value is actually the highest performer over this 20-year period at 8%, but that line moves a lot. And what that's called is the standard deviation. How far does it deviate from the mean? And so one way to balance out the standard deviation, but also not give up too much of your return, is to invest in stocks and bonds. And you'll see the balanced 60-40 portfolio, the one in green, is kind of right in the middle, and it doesn't have as much volatility. So over this 20-year period, you're still having an average return of 7.1% a year, but you've cut down significantly your standard deviation and the volatility over the short run to only 9.3%. And this chart, what it shows is it's not always one asset class that performs really well. I mean, we get lots of questions, well, is it time to go into oil? Are commodities going to do great? Well, you see from year to year, they could be at the bottom one year and in the middle the next year and at the top over time. So you find people a lot of times chasing last year's biggest performers. And if you look at this chart in detail, that's not always going to get you where you want to be. You've seen the highest performer in 2016 is emerging markets, but the year before it was one of the worst performers. This chart also is showing you right in the middle of the road, if you have an asset allocation of a little bit of each of these types of stocks and bonds in your portfolio, those tend to stay towards the middle of the pack. You're not going to have the highest performance in your portfolio or the lowest. You tend to be kind of in the middle of the road. Okay, so now diving into retirement planning. Retirement planning, I mean, you still want to have a nest egg set aside or emergency fund set aside, but you don't necessarily want to wait too long to do your retirement planning. There are real advantages of starting ahead of time, and one of the major advantages is the income tax considerations that go into play when you're saving for retirement. So Erin and Jen both kind of touched on, if you're working for an employer, they may have a 401k plan, and how that would work for you is if it's a traditional pre-tax 401k plan, by putting money into it, you're actually, the amount that goes into that plan, you're not being taxed on. So if you had $100 of your paycheck that you wanted to put into your traditional 401k plan, if you put $100 in, that goes in and gets invested right away. If instead you decided not to contribute to your retirement plan, let's say you're in a 25% tax bracket, you just take the $100, your employer is only going to give you $75 because the first $25 of that went to taxes. So there's a real advantage to being able to put that money away at the full pre-tax amount. And we also touched on some other types of employee benefit plans that work the same way with pre-tax dollars, your HSA accounts, those transportation accounts, your flexible spending accounts. And although the money went in that example, the $100 went in tax deferred, it doesn't mean that you're not eventually going to have to pay tax on that. When you do take withdrawals later on, hopefully in retirement, you will still pay tax on those pre-tax account dollars. But during that whole time period, you do not pay tax each year on the money that's accumulating. There are certain types of accounts where that's not the case, where you actually are going to have tax-free distributions for qualified expenses. So in the case of the HSA, it was pre-tax money going in, but if you use that money for medical expenses, you actually do not pay any tax when the money comes out, as long as it's going directly for medical expenses. A couple other types of accounts where you have tax deferral, but you don't necessarily get a deduction immediately, would be 529 college savings plans and also Roth IRAs. And Roth IRAs we're going to spend a little bit more time talking about later. And while you are getting tax deferral during that period of time, the IRS wants to make sure that these types of accounts are not being misused or used for the short term. So there is a penalty, typically a 10% penalty if you take them out before you're supposed to. Typically 59.5 is the requirement. Okay. So when we're saying tax deferral helps make your money grow, what we mean by that is each year that it's in a tax-deferred account, you're not paying tax on any of the earnings either. So you have that power of the compounded rate of return, and it just growing and growing, and we'll show some examples on the next few slides. And going back to, should you do a traditional IRA or a Roth IRA? The major differences are, do you need the tax deduction now? Are you in a high tax bracket? If you are, you may want to have a traditional IRA so you do get that pre-tax savings. Whereas in a Roth IRA, you don't get any deduction now, but when you take that money out, it's actually tax-free, and you have all those years of accumulated growth. So Roths are also very popular when people are young because you have a long period of time where you could just have your money growing and eventually take it out tax-free. Another thing to think about with Roth IRAs is there are income limits. So once you get past certain thresholds, singles around $118,000, marrieds around $184,000. Once you get past those thresholds, you can no longer make contributions to a Roth IRA. So that's another reason why early on in people's careers you may see them doing that when they still have the ability to make those contributions. The other big difference between the two is when you are in a traditional IRA, when you hit the age of 70.5, you are actually required to take money out. The IRS wants you to take money out and start paying tax over time. So there is a portion called your required distributions that need to come out each year after age 70.5. Roth IRAs do not have those limits. No money during your lifetime actually has to be taken out of the account. So it can continue to grow tax deferred and potentially tax free for the next generation. And this is just an example of showing the power of putting that money into an IRA or 401k. Since in our example, I mean, this one's showing $10,000. In our original example, we had $100 going in versus having to pay tax on it and only getting your $75. So that's, you know, slightly different numbers, but the same concept. The power of not having that tax coming out and having to invest afterwards. If you did that, you would have significantly less money. Also, because this account that's not in a tax-deferred account, you're paying tax on any earnings, capital gains, any dividends each year, where this one just keeps accumulating and grows tax-deferred. Now, there will be a distribution that's taxable at the end, and that's what they're showing. You will pay tax when you eventually take it out, but you would still, at this tax rate of 28%, you would still have $41,000 that you would get out, so you're better off. And then this is a really powerful slide. We talked about your goals at the beginning of the presentation and how, your goal might be 30 years out to become a millionaire. So what would you need to do, and what is time? How is time on your side to help you out with this? So if you wanted to have $1 million by age 65 and you're investing it in the market and you're earning 7% return every year, if you started investing at age 25, you would only need to put away $381 a month for the next, 40 years, to get to the $1 million. But the later you wait to start investing, the more that you're going to have to put away. So if you didn't start till age 55 and you want to have that money of $1 million in 10 years, you got to put away $5,778 a month. So as much as we say, you want to have an emergency fund and everything in place, and we still believe that, it is very powerful to start investing at a young age. And this is just actually another slide that just shows it as a linear chart, the power of starting investing at age 20 versus 35 versus 45, and how much your account could grow. So I am going to hand it over to Erin to do a little remark.
Yeah, so that concludes basically everything we kind of wanted to cover tonight. Obviously, there's a lot to consider when you're starting off and doing your, first kind of blown financial planning. We encourage questions. We're going to get to questions in a second, but if we would like to, offer our planning services to anyone that's out there listening that's interested, if you have, if you're referred by a family member or a friend, make sure that you're, contact them directly and just that, say I'd like to work on some financial planning. If you've been referred by someone that works with someone at EP and you have no direct advisor, feel free to call us here in Torrance, and we'd be happy to kind of match you up with someone. So with that, I'm going to turn it over to questions, if I can figure out how to do this. There we go.
Please read our disclosures.
Yes.